Things may be changing with the Fed, and could we get a surprise rate cut? Today we're going to break it down for you. My name is Paul Barron. Welcome back into Tech Path. Let's get going. I do want to thank our sponsor today, and that is iTrust Capital. This is a place where you guys can go out and get up your own IRA and do it in the way of crypto. And of course, there's a couple of ways you can do this. One, you can start a brand new one right there at iTrust. Join over 200,000 people that have already done this. Or you can take an IRA that you already have, transfer it in, and then begin your own crypto journey trading inside your IRA account. So that's the cool part. The other thing is there's no fees to get involved. All you do is pay your fees when you are making a trade within your IRA. So check it out. Use our link down below. It's going to give you a $100 funding reward to get started if you decide to set something up. It does help us out. So check out itrustcapital.com. Let's go over to a couple of points I want to hit on first. And the biggest one right here, I think, is the bullish news that continues to roll out of Wall Street. JP Morgan right now says U.S. stocks have escaped a black hole and have room to move a little bit higher. And this is coming from a lot of analysts that have already started to move in this direction. And I think the real question is if we do get a rate cut, is it a bad thing that could be happening if Powell decides that and the Fed decide that a rate cut is in order? Further into this, if you look at what's happening right now in terms of investment, foreign investors are pouring money into the U.S. stocks again. U.S. equity funds have attracted almost $1.5 billion in net inflows over the past month and since February. You look at that compared to European investors who've piled back into U.S. equities. And this, of course, is even during the trade war. So has this played out in a benefit for Trump's policies? We'll see. This is going to be watching the data of this flow in the next few months to determine how this is going to play out. Let's go over to a clip real quick because this is Jerome Powell talking about the framework and the guides in which they're going to build around this. Now, I don't know if this is reading between the lines of what he's trying to put in here, but listen to the clip and then we'll talk about it. Take a look.
Keeping longer-run inflation expectations anchored was a driving force behind establishing the 2% target in the 2012 framework. Maintaining that anchor was a major consideration behind the changes in 2020. Anchored expectations are critical to everything we do, and we remain fully committed to the 2% target today. In the current review, the committee is engaged in discussions about what we have learned from the experience of the past 5 years. We plan to complete consideration of specific changes to the consensus statement in coming months. We're paying particular attention to the 2020 changes as we consider discrete but important updates reflecting what we have learned about the economy and the way those changes were interpreted by the public. We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks. While our policy rate is currently well above the lower bound, in recent decades we have cut the rate by about 500 basis points when the economy is in recession. Although getting stuck at the lower bound is no longer the base case, it is only prudent that the framework continue to address that risk.
All right, so you can see that they're starting to, at least in my opinion, starting to create some optics around the potential of restructuring how the Fed is looking at the current economy. Obviously, their goal toward 2% in terms of inflation, which seems to be happening right now. Now, there's some other things that are playing into this. When you look at the pressure on not only banks, but the Fed, and I think in general, how investments are going forward. Here is Trump's administration preparing the biggest bank capital rollback. This is since 2008. If you guys remember 2008, that was the savings loan debacle that happened, caused a massive economic reset pretty much within the real estate market. A lot of restrictions were put on banks. If you look at what they're saying here, Trump administration is moving toward with a sweeping plan to loosen the toughest capital requirements imposed on U.S. banks since the 2008 financial collapse. Penalizing banks for holding low-risk assets like treasuries undermines their ability to support market liquidity. So what he's getting at here, and we'll get into this, what Powell is saying, is that the banks are too conservative right now. And if we don't get the banks active in the market, real estate loans, business loans, etc., starting to risk market liquidity, that is a problem for economic growth. That's the thing that, of course, the administration is trying to stimulate going forward. Powell also signaled that we need to work on Treasury market structure. And this is part of the answer that can be what he says, I think, reducing the calibration of the supplemental leverage ratio. Simply put, he's looking at right now taking a concept around leverage, against where we are in terms of the market positions, and is the Fed in a position where a rate cut could be coming in? So a lot of people are critiquing this, and mainly they're looking at it is that banks would be more exposed here. I don't know. Do you guys think that banks, if they were to inject back into the economy, that would obviously create more potential jobs, businesses, real estate loans, et cetera? If they injected back in as opposed to setting back and just holding U.S. Treasuries, how would that affect your life? Let me know in the comments down below if you think that would be a good thing for banks to continue on the conservative route, or no, they need to get active in the business. If the grants relief on sovereign debt or other countries might face all this calls to do the same for Eurozone bonds and UK gilts, this could trigger a new imbalance in the international system. And again, that's the point that I think the administration is trying to get to, is that they're trying to balance what's happening here in the U.S. versus what's going on in Europe in terms of potential of investment and growth, in just general growth like GDP. The Kobe is coming in with right now the PPI inflation, which is falling to 2.4. This was below the expectations, so pretty much in line. This is more of a validator from the previous print we got last week on traditional inflation. The key here is that everything is starting to slow down. Now, granted, Powell has said this, many analysts have said this, is that there may be a lagging effect here on these tariffs because they were held in position, that we might see inflation bump a little bit on its next print or two. So be on the lookout for that as we start to see that play out. Now, here's the real question. Here's CNBC breaking down whether they should cut or not cut. Take a look.
You're talking April. April 2nd, the tariffs were announced. April 9th, they began to be implemented. Then they were all changed again for the most part. Companies have about a little more than 3.5 months of inventory on hand. So the stuff that's being sold is probably largely pre-tariff inventory. So people in the markets want to look at the data, want to see the impact. The impact's not going to show up for a few months.
What they were worried about, suddenly they abandoned their growth concerns. I mean, it just seems clear to me if the inflation numbers are coming in a little bit weaker, and we're waiting for these growth effects, which are also lagged. Don't you think growth effects are lagged too? Why not preemptively do it?
Absolutely.
Why not preemptively do it?
Because easy money is not a substitute for a shortage of goods. And it may work out like you imagine it work out, Joe. It may work out like I'm forecasting. The truth of the matter is we don't know. And we don't even know what the tariff rates are going to be at this point because we're still in this renegotiation phase. The unemployment rate's 4.2%, which is right on top of where the Fed thinks full employment is. And inflation is too high. And yes, April, which is going to be a very noisy month, it is a bit better than we thought. But it's too soon.
And I totally understand wanting to wait until all of this passes through the economy and we can see exactly what tariffs have done to the economy. But by the time you wait, this is what we learned during COVID. If you just wait and wait and wait, you will be too late.
Yeah, well, and you know, that's the great name that Mr. Trump has for Mr. Powell, and that is Too Late Powell. And that may play out here. I would agree maybe with the analysts on the CNBC side is that it's very clear that I think at least when you look of trying to skate to where the puck is going to be, Powell is not necessarily doing that just yet. And I think the market kind of sees this coming, is that there is a little bit of an open window here. And even Larry Fink talked about this. We're going to have 90 days of volatility. I agree with that. And then after that, if the rate cuts are not in position, at least looming up to that, and Powell hasn't, possibly telegraphed that to a certain extent, that's when I think we would see a problem in the economy. And that could really spoil a crypto bull run in the fall. So you guys need to think about that. This is a very key thing right now. One other thing I want to get to when you look at markets is how many of the money managers are responding to what's happening, not only in crypto, but in general, even tech. Obviously, one of the biggest innovation funds out there is the ARK fund, and that's being led by Cathie Wood. Her analysts, I should say the ARK analysts now are saying that we predict big moves ahead for both Coinbase and Tesla. And I'll show you the ARK fund here in a second. But if you look at a couple of our points here, Tesla, Palantir, Coinbase, and of course Shopify, those are the big ones that they're banking on. And I'm going to show you guys their position right now. Here's the roll up of Cathie's ARK. Tesla leading number one at a 10% weight. Coinbase right behind it at 7.54. Roblox, Roku, The one I still think is the hidden gem might be Robinhood. And there's many reasons for that with everything that we're dealing with. But I think the key here for Robinhood is their ability to grow with the next generation investor. And I think that could play into it. The fact that she's invested in both Robinhood and Coinbase, you know, kind of covering both sides of the plate, which I think is good. Now, all of that being said, the issue with Coinbase that is hitting right now is they just got nailed with a cyber attack. And this, of course, is bad for them. Could it even kick them out of the S&P 500? I don't know. But this is what they got right now. If you guys already know this, name and address, phone, email, masked Social Security, so it's last 4 digits, masked bank account. So they're probably, the way that this will work is if you don't know what social engineering is, pay attention to that. This is where people call you and act like they know what they're talking about and get you to offer up information. Don't do that. Always double check, question everything out there, whether it's email, text, phone, does not matter. Question everything always and double check everything in relationship, especially to any of your exchanges. And let me know in the comments, if you had to trust someone right now with crypto, would you trust your bank, number 1, Coinbase, number 2, or Robinhood, number 3, and number 4, we'll just keep it as DeFi. So 1, 2, 3, 4, just put your number in there. 1, your bank, 2, Coinbase, 3, Robinhood, 4. Let me know if you would go the DeFi route and kind of control your own destiny. I want to go to another strategy that's going around right now, and that is how to play the Bitcoin scenario. And of course, you could go the ETF route. You could go direct exposure. Some people maybe, if they're new to crypto, aren't ready to do that just yet. Or you could go in and bet on a company that's really creating infrastructure around that, such as Strategy. Listen to this analyst right here. Take a look.
For decades, you usually long the market and then short a name against it. That creates the natural arbitrage and the hedge. There's Bitcoin 103,000. So you're long Bitcoin, you're short MicroStrategy. Yeah. And you have been for a good while?
A good while. You're on and off for the last couple of years.
Why so? Because it's so levered to the price of Bitcoin?
We're short the spread. So that's the important thing that your viewers need to understand. I don't know where Bitcoin's going. 100,000, a million, 10,000. I don't know. I don't think anybody else knows. But what I do know is it's generally profitable to short $1 for $2.50 or $3. And if you look at where MicroStrategy, and now more ominously some of the copycat companies that are now raising lots of money, are doing is they are basically selling retail investors the idea that we are going to buy Bitcoin in a corporate structure. Because of what MicroStrategy has done, you should value us at a similar premium. And therefore, earnings are created by the difference between what new investors are paying and what the net asset value is. But it's ridiculous. And so what we're doing is we're doing exactly what MicroStrategy and Michael Saylor are doing. We're selling MicroStrategy stock and buying Bitcoin. And basically buying something for $1, selling it for $2.50.
All right, so I'm going to say this really straightforward. I don't agree with his model. Now, granted, for me, I would just get exposure directly to Bitcoin anyway. But if you are looking at hedging and you're trying to figure out, I want to buy or at least have exposure to Bitcoin, but I'm not ready to buy Bitcoin, or I'm not ready to go into an ETF, then Strategy is probably your bet. If you look at what they're doing right now, MicroStrategy's Bitcoin, their premium under pressure right now. This, of course, is ETFs are getting a lot more popular, and that'll be the question mark. Do ETFs kind of eat this up? One thing I want to hit on here is this is being largely fueled by leverage and a narrative driven by retail investors. I want you to step back and think about that for a second, all right? Just instead of Bitcoin, throw the word AI in there. And think about that. It's being, by narrative and leverage of what's happening within the enthusiasm around the market. Now, granted, there is some technology there, but again, it's constantly changing. Bitcoin is a little bit different. Chanos' comments come after MicroStrategy has surged more than 220% in the last year. So if this guy was betting on that, it didn't turn out well for him. The other point I want to hit on right here is that if Bitcoin drops sharply, obviously Strategy would face risks like debt stress, dilution, more impairment losses, much like anything. I mean, if you look at the markets right now, what happened to NVIDIA when we started to see tariff imposed, what we saw with Coinbase's stock just here recently after a data breach. All these kind of things are going to hit markets and scenarios playing out within how you're investing. The key is, are you paying attention? If you're paying attention, you're okay, because it's also going to get hit. Bitcoin's going to get hit with a no rate cut, or more pressure on inflation. Those kind of things are all macro environment situations that you guys should be paying attention to anyway. So keep that in mind as you're betting. For me, it's Bitcoin Direct. If you're going to go with Bitcoin or altcoins, I feel like that might be the better route depending on how much your risk tolerance is. So think about those things. It's important right now because we're getting ready to roll into the next phase of innovation, and that's going to center around stablecoins. Now here, of course, is Eleanor. She's talking about something that's kind of interesting. It's the big tech language of page 2 in the Genius Act. Now, there was a statement and a video that we did yesterday that is really referencing this right here. And that is the idea that Meta, who needs a stablecoin potentially, would maybe look at Ripple as an acquisition target. Now, you got to think about this, guys, because I feel like we are in a position right now. First of all, I'm going to give you a little bit of insight. We're going to do a part 2 to that video that we did yesterday. If you didn't get it, go back and watch it, and you'll see where we're coming from. There's a lot of indicators there, but the big deal that came out on this is that big tech is now going to not be able to go in and be participating around what's happening within the Genius Bill, especially when it most likely comes to stablecoins. Now, if they get that through, then that means, I think about this because I'm kind of concerned whether it's going to be big tech, or could you consider also big finance in that? Because now you got BlackRock, JP Morgan, banks, etc. Are they precluding a whole industry from becoming involved in the financial industry? Very interesting times right now on Capitol Hill as they start to push this through. All right, you guys, if you're not in the Diamond Circle, get in on that. We're going to see a lot happening in the next few weeks. If you have not subscribed to the show, right now is your time. Hit subscribe right now. Join that Diamond Circle and follow me on X. Those are the 3 things you can do for all the work we do out here. It's just @PaulBaron. We'll catch you next time right here on TechPath.